In just a few days, the largest wealth transfer in American history begins. It is not a crash. It is not a bailout. It is a flood. $4.7 trillion is about to pour into the US economy, and 90% of investors have absolutely no idea it's coming. Wall Street knows. Institutions know. The money is already positioning. Trump's plan isn't just policy. It's a market catalyst, one that will create new millionaires and absolutely destroy portfolios that aren't positioned correctly. I'm going to walk you through the exact timeline, the 5 waves of capital flow, and the 6 sectors that will absorb this money first. But here's the catch: the window closes fast. Here's what most people miss. Trump's 2025 tax cuts, the so-called Big Beautiful Bill and Jobs Act 2.0, were never just about lower taxes. They were about timing. The bill passed in March 2025, but the economic impact hits in 3 major waves. Wave 1 runs from April to June 2026. Tax refund season, except this year it's being pulled forward. Refunds are starting as early as late February. Wave 2 runs from July through September. Corporate repatriation. Wave 3 hits in the 4th quarter. Bonus depreciation and capital expenditure. Now here's why this matters. According to Congressional Budget Office and Treasury estimates, individuals will receive roughly $1.2 trillion in tax refunds, about $8,500 per household. Corporations will receive approximately $2.1 trillion in repatriated overseas cash, and another $1.4 trillion will flow into accelerated depreciation and business investment. That's a total of $4.7 trillion entering the economy in just 9 months. For context, that's 3 times the size of the 2008 bank bailout. The COVID stimulus package was about half this size. This is nearly 20% of the entire US economy hitting the market in less than a year. We've seen this before, just not at this scale. Look at the 2017 tax cuts. The S&P 500 rallied 28% over the following 18 months, driven by just $1.5 trillion. The Bush tax cuts saw small caps surge 47%. The Reagan tax cuts in the early 1980s saw the Dow rise 135% over the next 5 years. But here's the critical difference. In 2026, we already have historically low unemployment. The Fed is cutting rates, and consumer demand is still pent up. This isn't a recovery cycle. This is rocket fuel poured onto an already hot economy. And this is exactly where most investors mess it up. They react instead of anticipate. By the time CNBC starts talking about a tax refund rally, the easy money is already gone. The institutions are already positioned. The smart money is moving now before refund checks ever hit bank accounts. This $4.7 trillion doesn't hit all at once. It flows through 5 distinct waves, and each wave creates different opportunities. Miss one, and you leave money on the table. Wave 1 is where we are right now. The bill has passed, but the money hasn't moved yet. This is when institutional investors front-run refund season. Volatility drops, the VIX fades, uncertainty clears. So where does capital start flowing? Historically, this phase favors small caps, consumer discretionary, and home builders. In late 2016, right before the prior tax cuts, small caps rallied 15% in 3 months. Large caps gained just 6%. The Russell 2000 outperformed the S&P by 9 percentage points in a single quarter. That's the setup we're seeing again. Wave 2 is where things get explosive. This is the refund flood. And if you were paying attention earlier, you know it's coming earlier than ever. Late February, the earliest in history. That's $1.2 trillion hitting consumer bank accounts. The average household is about to receive roughly $8,400. So where does that money actually go? We have historical consumer spending data. About 35% goes straight to debt repayment. Credit cards, auto loans, personal loans. Another 25% goes to discretionary spending, vacations, travel, home improvement, electronics. Then roughly 20% goes into savings and investments. And the final 20% goes to necessities. So what happens next? Retail stocks love this. Amazon, Walmart, Target, Home Depot, Best Buy, travel and leisure love it too. Airlines, hotels, cruise lines, booking platforms. When people suddenly feel richer, they don't sit at home. They move. Brokerage firms benefit as well. Robinhood, Fidelity, Schwab, more cash hits accounts, more trading activity follows. Even credit card companies rally. Visa, MasterCard, American Express. When spending increases, transaction volume rises. If you want a historical example, look at the 2008 Bush stimulus checks. Retail sales jumped 12% in the single month. Those checks were distributed. This time around, the stimulus is 7 times larger. Now let's move to Wave 3, corporate repatriation. The tax bill includes a one-time repatriation holiday, allowing US corporations to bring overseas cash back into the United States at a reduced tax rate. We're talking about $2.1 trillion currently parked in foreign accounts. Who benefits most? First, mega-cap tech, Apple, Microsoft, Google, Meta. These companies alone hold over $500 billion overseas. Second, pharmaceutical giants, Pfizer, Johnson & Johnson, Merck. Third, industrial conglomerates, GE, Honeywell, United Technologies. What do companies actually do with repatriated cash? History gives us a clear answer. About 40% goes into share buybacks, which mathematically pushes remaining share prices higher. Another 30% goes into dividends. About 20% goes into mergers and acquisitions. And the final 10% goes into actual business investment. The last time we had a repatriation holiday was 2004. Companies brought home $312 billion. The S&P 500 rose 15% that year. Tech stocks rose 22%. This time the repatriation is 7 times larger. Now let's move to Wave 4, bonus depreciation. The tax bill allows companies to write off 100% of capital investments immediately instead of depreciating them over multiple years. That creates a massive incentive to spend now. Who benefits? Heavy equipment manufacturers, Caterpillar, Deere, 3M, construction and engineering firms, Fluor, Jacobs Engineering, infrastructure and systems companies, Cisco, Oracle, Salesforce, energy and utilities, grid modernization, solar, wind, transmission upgrades. This wave alone represents roughly $1.4 trillion in capital expenditure. A huge portion of that will go into automation, artificial intelligence, energy infrastructure, and reshoring supply chains back to the US. In 2017, business investment rose 6%. Industrial stocks climbed 34% that year. Commodities, especially copper, tend to outperform when infrastructure spending ramps up. But here's the uncomfortable truth. Flooding $4.7 trillion into the economy doesn't come without consequences. It will create inflationary pressure, and the Fed is going to respond. In a normal environment, inflation would trigger rate hikes, but 2026 is not a normal environment. We are getting rate cuts. Why? Because Trump wants them. After the midterms, if inflation accelerates and we start pushing back toward 3%, then yes, rate hikes come back on the table. That's the risk window. You've probably noticed it already. Lowering oil prices, capping credit card interest rates at 10%, pushing to lower housing costs. The goal is simple: make everyday inflation feel invisible. But here's the part most people miss. The real measure of inflation isn't groceries or gas. It's asset prices. If the stock market rises 25%, that is 25% inflation. Your salary didn't go up 25%, but people who own stocks, real estate, gold, silver, and other hard assets just got 25% wealthier, which leads to the only logical conclusion: put as many dollars as possible into assets. That's how this system works. So where does the money go? For Wave 2, the refund flood. The obvious winners are consumer-facing giants. Amazon, Home Depot, technology is still a major beneficiary. Apple, Microsoft, Nvidia, Alphabet, these companies print cash. Financials also benefit. M&A activity picks up. Investment banking ramps. JP Morgan, Goldman Sachs, they thrive when deal flow returns. Brokerage platforms benefit too. Schwab, Robinhood. Retail trading surges when liquidity rises. As we move later into the year, energy comes back into focus. Exxon, Chevron, ConocoPhillips benefit. Energy majors don't move overnight, but when inflation expectations return, they matter. Real estate also works. Tax refunds function as down payments. Combine that with falling interest rates, and housing demand explodes. REITs benefit. Industrial and warehouse REITs are already performing well. Residential REITs become more attractive as rates come down. There's one more beneficiary people keep overlooking. As interest rates come down, SoFi student loans are going to get refinanced, and SoFi is the #1 student loan refinancing platform in the country. Lower rates mean refinancing volume explodes. So what does the timeline actually look like? If you want to front-run this cycle, small caps tend to benefit early. Consumer discretionary holds up through the middle of the year. Through the summer, corporate repatriation starts to shine. Mega cap tech and dividend payers step into the spotlight. Then we move into the third quarter. That's when the capital expenditure boom kicks in. Industrials come into focus. Materials and commodities tend to perform. Steel, aluminum, copper. I remain very bullish on gold and silver. It'll be choppy, especially silver, but structurally bullish. Toward the end of the year, that's when we start watching inflation closely again. Gold, Bitcoin, energy stocks. That's also when it may make sense to start taking profits on the highest valuation growth and tech names. Could something go wrong? Of course. The Fed chair could decide to do his own thing. Consumers could decide not to spend. But even if they save, the money still flows, just differently. Savings flow into brokerage accounts, which still supports markets. Some people will say this is already priced in. I don't buy it. When I talk to people outside of very informed Wall Street circles, they're shocked this is even happening. So if you're watching this, you're already ahead of the curve. Before we wrap up, I want to leave you with this. Gold and silver are both sitting at or near all-time highs, and your gut might be telling you that you've missed the boat. But central banks are buying gold at levels we haven't seen since 1967. If you found value in today's breakdown, don't forget to like the video and subscribe. This Wisdom Wealth channel, and I'll see you in the next one. This is not financial advice.